In this week's update, short squeezes and GameStop. Is this the top? Getting your timing right for re-entry, and we'll look at the Bitcoin chart as well. My name's Garry Davis, and as always, this is general advice only, and please remember to subscribe and like the video. Okay, the big story this week has been the short squeeze in America, and in particular a stock called GameStop, although there were a few others. And you would have to have shut yourself off completely from the media not to have been across this story, because it's hit the mainstream press, the evening news. It's been absolutely everywhere. It's a great story for the press, but we've got to keep this in realistic perspective here, because bursts of market manipulation go on periodically, always have and always will. I don't think there's anything particularly different this time, except that the little guys are leading the charge. They've got a tool that gives them collective power that they've not had or not been able to put together before. But market manipulation goes on all the time. Most of it is sanctioned by the regulators. It's still market manipulation, and it still creates a very unlevel playing field. And what's happened in America is an attempt by retail traders to try and level out the playing field. So this will pass, this phase will pass. And frankly, the excessive price swings that we've seen can be handled. So you need to turn away from all this hysteria about the fact that this sort of price movement is an indicative of the top in the market. Because there's every chance that it's just another passing phase. So what you need to do is just be clear about your game plan and exercise good discipline. You don't have to stay out of the market. You don't have to trade in GameStop. You can trade in other stocks, and you can handle this level of price swings. And we've seen some tremendous price swings in Australia, in stocks like Novonix and Vulcan Minerals, for instance. So you don't have to miss out on the action just because prices are fluctuating around quite wildly. Now, the naysayers have jumped all over this to proclaim that this sort of wild action proves that the market is in a bubble, which is going to burst and we'll all be decimated. And yes, there could be a correction from here, but I severely doubt it. But look, that would be normal. If we do get a correction, that would be absolutely normal. So let me ask you this. Is 5G going to stop or slow down the evolution of 5G? What about artificial intelligence or advances in genetic medicine, digital payments, 3D printing, robotics? Are any of those going to suddenly slow down or stop? And what about Bitcoin, now that the institutions are clearly starting to allocate a portion of their funds to it? So if all those things are going to continue to grow, then just do that. Don't worry about the general market. Just focus in on what is an incredibly high probability of panning out. Find the leaders in those sectors, buy the dips, manage the volatility, and you'll be absolutely fine. In fact, you'll probably do really, really well. So that's the overwhelming message I want to get across today. And as usual, the media is just going off, and it can really lead you down the wrong path. So in the short term, yes, we might see a little bit more disruption, but I'm going to talk about more on that in just a minute, because I don't think it's going to amount to a great deal. All right, so this certainly was a historic week. And just to recap, but I'm sure everybody's pretty much read the story, Wall Street beats. What is the fallout of some 5 million retail traders coming together collectively to exercise their power? Well, we've seen them turn their focus to the hedge funds that have been short selling certain stocks, and they've caused what's called a short squeeze. Now, I don't want to go into that in this forum. If you don't know what a short squeeze is, then just Google it, and I'm sure you'll get all the information you need. But it's effectively forcing hedge funds to reverse the short positions that they had on certain stocks, And in many cases, they've had to sell high-quality names and cop very big losses. So some of the reduction that we're seeing in the market is not a consequence of the fact that the funds want to sell Apple or Microsoft or whatever. Some of it is forced selling because of liquidity reasons to cover their losses elsewhere. And you can also bet that this is not just the retail traders versus the hedge funds. You can bet your life that some hedge funds that aren't short some of these stocks are taking advantage and devouring some of their peers as well, because that is a dynamic that goes on in the hedge fund industry all the time. So the masses have discovered a tool to make big profits, fast profits, and it's a very dangerous game if you don't know what you're doing. But is this really a game changer? Is this going to change the dynamics of the stock market? I severely doubt it. And one of the main reasons is that the shorts in question form less than 2% of the market. So at this stage, we're only talking about just a sliver at the side. It's getting all the media attention, but it is just a sliver at the side. So my advice would be, unless you're a real dyed-in-the-wool short-term trader that loves this sort of stuff and is experienced enough to play that game, is just let the speculators slug it out. Don't get involved in these particular stocks. I'm not chasing GameStop or any of those. It's too wild for me. But am I involved in a lot of the megatrend stocks that are also, pretty volatile? Absolutely. So just stay with the sort of stocks in the areas of the market that you're comfortable with, and you should be fine. Just looking at the short-term roadmap, this isn't a prediction, this is just what's probable based on how the market behaves. Given that we're now getting a bit of disruption, and also we're seeing the Vix index at quite an elevated level, it's highly likely that we're in for just a little period of volatile consolidation. Now that could be a few more days, it might be a few more weeks, I have no idea. We'll just play it as it comes. But then when that is complete, down to whatever level the market goes to or however long it takes, then I think we're going to see a very strong rally at the index level, because earnings are good in the States. This is a pretty good environment for a lot of stocks. And then I think you can expect to see these megatrend stocks in all the areas that I talked about before do far better than what the indexes are doing. It's been happening for the last couple of years, so why wouldn't that continue? So my recommendation would be not to shy away from buying something that looks compelling. Then it could be a combination of a very compelling fundamentals and compelling outlook, together with a technical dip. Now it depends on how you trade and what information you take into account. But if you've got something that ticks all the boxes, then don't shy away from buying it, because often some stock prices go up even though the market's going down. Just look at what happened in the crash in March last year. There was a small number of stocks, like Fortescue Metals, for instance, that actually only went down for a couple of days and then went up very much against the rest of the market. So if you've got something compelling, then don't hold back. If you wish to cash up a bit, and that's probably not a bad idea for most people, then tighten up your stops. I think that's a better way to do it than just to sell things, because who knows, maybe this blows over by tomorrow night and the market just goes straight back up again. We have no way of knowing. So rather than just exiting things on chance, just put really tight stops in, and then if the market goes down, then just let the market take you out, rather than make a premeditated decision to reduce your exposure. And if some stocks don't go down, then great, you're still in them and you're still profiting. So I think that is the way to play this market. So in terms of getting your timing right, let's talk about the VIX. The VIX is an excellent tool for timing, helping you time the market. It's rarely above 40, as we'll see when we look at the chart in a minute. and generally only for a few days. Now, there are one or two exceptions. 2008 was an exception. March last year was an exception. But they're extremely rare events. And the circumstances for something extended above 40 is just not there at the moment. So one would think that if the VIX does kick up above 40 in the next few days, that we're going to be very close to a short-term bottom in the market, because it got to about 38.5, 39 on Thursday and Friday. So in that case, if we're likely to be close to a peak in the VIX and therefore a low in the market, why would long-term investors need to worry about doing anything? Just take a step back and look at perspective. I don't think this is going to amount to anything terribly much. Now, if you're a short-term trader, then that's a separate issue altogether. You do need to pay more attention to this sort of short-term volatility. But long-term investors, I think, rather than worried about these short-term fluctuations in the market, should be far more concerned if you own non-mega trend stocks. So if you own just, the normal garden variety, industrial type stocks that, the pundits tell you are the sort of stocks that you should own, then you should be far more worried about that than about short-term movement in the market. So that's my overall perspective on where things sit at the moment. Let's just take a look at the VIX for perspective. So let's go to the maximum here. So this is the VIX index going back to 1990. So you can see that this level here is 40 and this level here is 50. So you can see that the excursions above 40 are pretty rare, and the excursions above 50 are even rarer. So 2008 and March of 2020. So that is the big picture. And if you look at when the market is quite complacent, the VIX tends to be between 10 and about 18 typically. So we've got a long period of that in the 1990s. We got another period leading up to 2008 when the market got pretty complacent. We had another period 2013 through to 2015, another period into 2018. But what has happened since March of last year is that the VIX is now running at a much more elevated level, and we can see that when we zero in. So you can see that this is the crash in March, so the VIX peaked. But what is really instructive about this chart is that these peaks in the VIX occurred at bottoms in the market. So in 2008, that extreme level on the VIX corresponded with October in 2008, which was effectively the bottom for some parts of the market. And in March, the peak in the VIX occurred when the market got to the bottom. Yet here, we continue to trade on the VIX between 20 and 40, or 20 and 30 for most of the time. But that is far higher than the normal base level. So that tells you that the market in general is far more nervous now than it has been for decades. And the fact, and what is really interesting about what happened in the last couple of days, is that the VIX hit 38 and currently sits at 33, even though the S&P is really only a whisker off its all-time highs. Now that normally doesn't happen. So we've got an unusual set of circumstances at the moment, and it's telling you that the market is really more nervous than it normally is. But nevertheless, spikes above 40 in the VIX are very rare and they're very brief. And unless you think we're running into another set of circumstances like March last year or 2008, then one would expect that we're probably pretty close to a peak in the VIX and therefore a low in the market. So that's just going with the weight of probabilities. So let's go and look at some of the American stocks now. So the S&P ended up falling 3.3% across the week. Now the good news is that earnings coming through are mostly well above expectations. So earnings season is again proving to be pretty robust in America. The VIX was up 33% on the week, and the finish was negative. So there's no question about that. And we may not have seen the peak in the VIX and the bottom in the market yet. It was the worst week in 3 months. So just to give you an idea, we've had a terrific run through November, December, and January, and this was the worst week since October of last year. However, and this is a really, really important point, roughly 350 S&P companies have raised guidance. Now, in America, share prices are buoyant, as everybody knows. CEOs don't need to talk up their stock. They don't need to raise guidance to try and get their share price up. And in fact, the game that's normally played in America is that CEOs like to underpromise and overdeliver, and the market loves it and pushes the price up further. So American CEOs have little incentive in this environment to raise guidance. Nobody would blame them if they didn't because of all the uncertainties around COVID. Yet they are raising guidance. So what does that tell you about their level of confidence in how their businesses are going? I think it says a great deal. Now, the US dollar was steady at 90.58. Yes, it's holding support, but as we'll see, there's not really been a bounce. It's been pretty flat. The 10-year yield dropped slightly. It did get up close to 1.2 at one stage, a bit over a week ago, but has eased back a bit, and it's at 1.06 at the moment. So let's jump in and look at some other charts. So we'll start with the S&P. So you can see the dips that we've had along the way. We had a dip below the 50-day moving average in September. We had another dip which got a bit closer to the 200-day in the end of October. Since then, the market has been tracking above the 20-day and has now breached that and is on the cusp of breaching the 50. But look, let's be realistic. That is normal. You're always going to get little pullbacks that are going to breach the 50-day moving average. A more important level is breaching the 200-day. So that that's a level to keep an eye on, which is at the moment is around 34.72. But I don't expect the market is going to get down to that level. Just looking at all of the dynamics that are involved, I would think that this level around 3,600 is more likely to provide support, or perhaps just a little bit under it. So I think that's the more likely support area. But look, just let the market guide you. Don't go in with any preconceived ideas. Just work off what the price action is telling you. It's never been as important as it is now. Let's look at the NASDAQ. Similar position. In fact, just a little bit stronger than the S&P. It hasn't breached the 50-day yet. And if we look at the Russell, so the Russell had broken to all new all-time highs. Just come down through the 50-day, but small caps looking very strong as well. So things are all ticking along reasonably well on that front. This is the US dollar. So you can see the 50-day moving average, the blue line, is telling you that the dollar is still in decline. We have reached a major support level. So it's absolutely normal that the US dollar would be finding support here because this is a really key level. But look, it's not bouncing. There's no bounce in it. So it's hard to see, just purely looking at that chart, that the US dollar, it's not showing any signs of bouncing. You would have thought that there'd be some enthusiastic bouncing off that support. It's not happening. So I think the likelihood is that the US dollar at some point will resume its downtrend. And that's just kept a little bit of a lid on the gold price as well. Now, if we look at the Australian dollar, so we got up almost to 78 cents, finished the week at 76.1 on the Aussie dollar. Right, turning now to Australian stocks, 76.1 is where we finished. Commodities reasonably flat during the week. Now, our index lost 2.8%, but what was notable about the last couple of weeks is that finally, some of the Australian small caps that have got tremendous stories, particularly in the areas of battery materials, are now joining the party. You know, there's been a lot of very, very good stocks that the market just didn't seem all that interested in. But now there's a whole lot of them starting to move, and that is very good news. So the battery materials are leading the way, but there's plenty of others as well. So let's just take a quick look at the Aussie index. So I would expect after the Wall Street finish on Friday night that we'll probably see a bit more downside in the Australian index on Monday. Now, turning to precious metals, because there certainly is plenty of action here, and there is an attempted short squeeze happening in silver. Whether it gains the sort of legs that occurred with stocks, other stocks in America like GameStop or not, remains to be seen. I severely doubt it, because GameStop was a speculator's heaven. It's just purely based on opinion and some market dynamics, whereas silver actually has underlying supply and demand issues. Institutions are involved. It's an industrial commodity, so they won't be able to squeeze silver in the way that they did GameStop. But nevertheless, there is an attempt being mounted at the moment. Now, gold finished down $6 to $18.48 on the week. So gold's not really doing anything much, but silver outperformed quite significantly. The performance of gold of late has been disappointing. This is a strong period of the year for gold, so I must admit I am a little disappointed in the fact that gold hasn't yet done better in this period. We get the end of February, early March is when gold tends to go off the boil. So if we don't see something unfold in the next week or two, then we're probably not going to see it until later in the year, when we get into another seasonally good period for gold. But silver certainly had a great week. Silver was up, I think, about 5.5% on the week, and we'll look at that chart. And when we look at precious metals, the profit position for the major gold producers around the world should come in pretty well. The gold price has held up reasonably well. Production levels have come up now that they've got out of COVID shutdowns, and all-in sustaining costs have been coming down. So we should see good results. But look, often gold stocks aren't really priced on their results and pure valuations. It's really about forward expectations. Now, if you want to get involved in getting some exposure to silver through silver stocks, then my advice would be that you look for silver stocks that are already moving. Now, we don't have very much to shoot at in Australia. There are more opportunities in North America, but there are one or two in Australia. So look for the ones that are moving. Don't look for penny dreadfuls that may not necessarily move even if the silver price does go up. Look for the ones that are already moving, or the ones that have got some near-term announcement catalysts coming. That would be the area to be looking, in my view. Okay, so let's start with silver. So silver, you can see, had a pretty buoyant week, and Thursday and Friday was particularly strong as the short squeeze in America started up. And you can see it's above all of the moving averages, the 200, the 50 and the 20. So silver looking quite strong. If you look at gold on a daily, you can see we've got a really tight convergence. Gold really just not doing anything very much in the last few weeks. So silver clearly outperforming gold. And if we look at this on a ratio, so this is the ratio between silver and gold. We we peaked out in March at around 124. It normally would sit around the 55 to 60 mark. We peaked out at 124 when silver got absolutely murdered in March of last year. But you can see we came down to around about 70 on the ratio. We then bounced. So in other words, during this little period, silver was underperforming gold. But now we're now back trending again. And so the fact that this line is dropping means that silver is doing better than gold. And that was obvious from the last charts that we just saw. And if we look at GDX not really doing anything. It's really just a sideways movement, which has been the case since the middle of November. So not much happening there with GDX. All right, turning to other commodities, copper eased to $3.54. That's really just currency related. It's a very positive long-term story around reflation and industrial metals. Crude was slightly higher again, but not a lot of change there. And as I've been saying, crude oil is anything but a mega trend, so therefore I'm just not interested. There's so many things that we can shoot for in mega trend areas, and so many stocks within those that, why would you bother with anything else, to be honest? All right, there's the spot copper chart. And just wrapping things up now, the short-term play, if you're looking to do some opportunistic nibbling, I think that's okay. There may be a bit more downside in the market yet. So if something's compelling, then yeah, buy a little bit. But I would be waiting for a peak in the Vix and a reversal in stocks. So the Vix peaking out and coming back down, and stocks bottoming out and starting to turn up with some decent volume before getting aggressive. So I think it's okay to do a little bit. Run tight stops. If the market decides it's going lower, then you'll get taken out, you'll be cashed up, and you'll be sitting nicely for the next phase. The really important thing here is being in tune with the message of the market and not with what you think should be happening. It's so easy for us to get an opinion about the market and then stick to it. And what tends to happen is we tend to go and look for information that confirms our bias. You want to avoid trying to do that. Just look at what the charts are telling you, the message from the market, and just use that as your cues. Now, Portfolio Analyst last week, for anyone that's not tried Portfolio Analyst, there was a great deal of, I think, very good strategic and educational information. Specifically, I looked at avoiding pitfalls in the market in a number of different areas. We looked at precision medicine and healthcare with some, with a couple of pretty exciting opportunities over the long term in those areas. We looked at sector weightings and trade management, so quite a bit of strategy around that. Looked at the ETF market, the pros and cons of being in ETFs. And there was also, of course, portfolio reviews, and the portfolios in Portfolio Analyst are doing extremely well. So if you haven't tried Portfolio Analyst, the trial, you get one time at it, costs you $1 for 2 weeks, and there's an enormous amount of educational content in there. So I'd recommend that you try that. All right, that's it for this week. There's my email address and information on the website, and I'll be back with you next week. Cheers.